Good morning. So let's work out another illustration on computation of capital gain. And this is for financial assets. We have already done an illustration in the last class. So let's do a couple of more illustration just to make your understanding more clear and more precise. So this is the chart which will aid you in understanding the computational aspect of capital gain pertaining to financial assets. So as you can see here, when it comes to computation of financial assets capital gain, we have to classify the financial assets into two broader categories. One is the listed securities and the other one is the unlisted securities. We have already gone through this chart in detail in the previous class, but this is just a recap. So when we say listed securities, these are those securities which are publicly traded. So these are the securities which can be bought and sold by public, by investors in stock exchanges. On the other hand, unlisted securities is a term which is quite opposite to listed securities. So unlisted securities can't be traded publicly. It's not accessible for public to trade on any of the stock exchanges. So these are securities which are privately traded between the shareholders, between the investors. Now, when we say securities here, we are referring to two different categories. One is the shares and the other one is the debt securities. And both shares and debt securities sometimes can also be indirectly traded through mutual funds. So when it comes to listed securities, the holding period is 12 months. So if they are bought and sold within 12 months, then it will be short-term capital asset. And if it is more than 12 months, then it becomes long-term capital asset. However, this is different in case of unlisted securities. Here, the difference is again on the basis of shares and debt securities. In case of shares, the holding period is 24 months. And in case of debt securities, the holding period is 36 months. Now, when we did the previous category, which is appreciating and depreciating assets, I was telling you that the benefit of indexation is applicable only for long-term capital assets. Only long-term capital assets qualify for indexation benefit. However, here there is a small twist, and that twist is something which you people have to remember. So in case of financial assets, the benefit of indexation is not available even for long-term capital assets. However, there are few exceptions. The benefit of indexation, even though generally it's not available for financial assets. However, in case of unlisted shares, equity and debt mutual funds, the benefit of indexation can be claimed. So unlisted shares, equity and debt mutual funds are the only exceptions. Otherwise, for long-term financial assets, the benefit of indexation is not applicable. And during the previous class, we had also discussed that one of the important adjustments which you will get in this financial assets is the valuation of bonus shares. Now, bonus shares are those shares which are issued free of cost. So company gives bonus shares only to its existing shareholders, right? So existing shareholders in a certain proportion get bonus shares. So since bonus shares is issued free, so there is no cost involved. But when we compute capital gain, right, in order to determine what is the capital gain, we need cost because we deduct cost from the sale consideration. So in case if the bonus shares are issued free of cost, then how do we value the cost of bonus shares? So the answer to this question is simple. If the bonus shares are issued on or before 1st April 2001, then the bonus shares will be valued at fair market price or the fair market value. And in case if the bonus shares are issued after 1st April 2001, in this case, the cost of the bonus shares will be taken as zero or nil. So that's the difference between the valuation of bonus shares based on when the bonus shares are or were issued, right? So you have to also remember this, which would help you in computation of capital gain, especially in case of financial assets. So let's do another illustration. So this time we have a small change here in comparison with the previous question. So this is illustration number 2. So you can quickly go through this illustration number 2 in your handout. So on 1st January 2000, Mr. Karan bought 1,200 shares of Advance Private Limited, which is an unlisted company. So these are unlisted shares. And he purchased these shares at rupees 50 per share. And the fair market value of these shares on 1st April 2001 was rupees 40. Now, what do you understand by fair market value? Fair market value here refers to the market price of the shares on a specific date. Now, you might be wondering, how will we get this data? Who maintains all these records? So there are designated authorities who maintain all the records. So if you want to know what was the price at which Infosys share got listed way back, decades back, you have the access, you have the availability of data. So fair market value information, or the market price of all the shares which are traded or which are not traded, right, are maintained by the competent authorities or certain organizations, right? In case of property like house, land, all the valuation, the pricing records are maintained by the local authorities, right? So it can be BBMP or BDA. In case of shares, the stock exchanges do maintain the pricing data, right? So fair market value means the market price on a particular date. So here, even though this assessee had bought shares for 50 rupees on 1st January 2000, the fair market value was 40 rupees. So that's the fair market value. Now, on 12 December 2006, what has happened is Advance Private Limited has declared bonus shares, and the bonus shares is declared in the ratio of 2:1. That means for every 2 shares held by the shareholder, he gets 1 share, right? So let's note down that, right? Because we need it for computational purpose. So bonus shares were issued or declared on 12/12/2006. And the ratio of bonus share issue is 2 or 1 bonus share for every 2 shares held. So let's write this. 1 bonus shares, 1 bonus share for every 2 shares held by the shareholders. So what happens here is, let's convert this into fraction. So this 1:2. When you convert this into fraction, it becomes half. So half into 1,200 original shares. So you get 600 bonus shares. Okay, so because our task was to identify how many bonus shares are issued, so bonus shares 600 he has. Now next comes to valuation of bonus shares. Now, you know that in case if the bonus shares are issued after 1st April 2001, the value of bonus shares will be taken as nil. And in this case, bonus shares were issued when? So the data is given here. On 12 December 2006, bonus shares were issued. What happens here is the value of bonus shares would be considered as nil. Since the bonus shares are issued after 1st April 2001, value of the bonus shares will be taken as nil. Right, so that's what you're supposed to write. Okay, so now let's do the computation part. Computation of capital gain, taxable capital gain of Mr. Karan. Is it Mr. Karan? So that's another point which you have to note down here. So let's read the question. On 1st January 2001, Mr. Karan bought 1,200 shares of Advance Private Limited for rupees 50. The fair market value of these shares as on 1st April 2001 was rupees 40. On 12 December 2006, the company has declared bonus shares in the proportion of 1:2. That is 1 share for every 2 shares held by the shareholders. But what happens here is quite interesting, and this is also important from the viewpoint of computation. It says in the previous year, that is 1920, Mr. Karan gifted his shares to his son, Mr. Arjun, and Arjun has sold all these shares on 1st June 2019. So we are computing taxable capital gain of Mr. Arjun because he is the owner of the shares and he sold the shares during the previous year and he got the shares from his father. Now, what happens here is that since he got the shares from his father as gift, obviously he has not paid for it. He has got it as a gift, which means it was given just like that, just free of cost. So as I mentioned in the previous classes also, in case if the assessee receives capital asset as a gift, then at the time of valuation for tax purpose, the cost of the previous owner, the cost paid by the previous owner or the purchase consideration paid by the previous owner will be considered as the cost of acquisition. So the cost of the previous owner will be deemed as the cost of the acquisition. So that is what we are supposed to do. So we have two categories of shares here. One is original and the other one is bonus shares. So let's do the calculation, right? So first, as usual, we'll write the sale consideration, which is our first step. So at what price these shares were sold? It's given here. Arjun sold all the shares for rupees 1,000. So we have two categories here, original. So original shares are how many? Original shares which he bought are 1,200. 1,200 into the selling price, which is 1,000 per share. So let's write here 1,000 per share. Okay. Now, At what price did he sell the bonus shares for? Same price. So bonus shares were also sold for the same price. But how many bonus shares are there? So we have 600 shares into, again, 1000 per share. So this constitutes your sale consideration. So 1200 shares, and these 1200 shares are being sold at the price of 1000 per share. So you get 12 lakhs, and here you get 6 lakhs. Next comes your sale consideration is over. So next is you have to deduct the transfer expenses, the expenses incurred in selling the shares. So what is the transfer expense? Again, it's given in the question. If you look at the second line, it says these shares were sold by paying a brokerage of 2% on the sale value. So original shares are sold at rupees 12 lakhs. Rupees 12 lakhs into 2%. Likewise, bonus shares are also being sold. Bonus shares rupees 6 lakh into 2%. So let's do the calculation. So here you get 24,000, and here you get 12,000. So the net sale consideration will be 11 lakh 76,000, and here it will be 5 lakh 88,000. So we have computed the first step. Now let's move on to the next important step, which is determining the cost of acquisition. Now these are unlisted shares. Now you look at the criteria for unlisted shares. The criteria is 24 months. More than 24 months, it is long term. So is it being held for more than 24 months? The answer is the original owner bought it in the year 2000, and the existing owner has sold it for 2019. So the period of holding is obviously right more than 24 months, right? So that's so 24 months is the period of holding, right? So don't get confused with this. Even though the original owner got the shares only in the previous year, but the original owner had this, right? He bought it in 2000. Now since the shares were gifted, right? So obviously gifting was given, right, out of love, free of cost. So therefore we are considering the cost of the previous owner, and therefore this date also we are considering of the previous owner. So this is obviously more than 24 months, and it is therefore long-term capital asset. And in case of unlisted shares, they are entitled for indexation benefit. So let's calculate the cost of indexation. Now again, as I always say, whenever you do indexation, figure out which equation to be used, because we have two equations. One equation is for those capital assets which were purchased on or before 1st April 2001, and the second equation is for those capital assets which are bought after 1st April 2001. Now these shares were bought by the original owner on 1st January 2000, which means this is before 1st April 2001. So we will be using the first equation. So the first equation is this. So let's substitute the values now. ICOA is equal to cost of acquisition. So cost of acquisition is rupees 50 per share, or fair market value as per the question is rupees 40 per share, but we should take whichever is higher into 1200 shares. Okay, so this is what we are supposed to do it. So obviously we will take 50 because 50 is the higher value. Now let's simplify this. CII of previous year 18, 19, 20 is 289, which is given in the question. 289. So 50 divided by 50 multiplied with 1200 shares divided by 100 into 289. So when you simplify this, you get rupees 1,73,400. This is your index cost of acquisition. 1,73,400. Now what about bonus shares? So as far as bonus shares are concerned, there's no confusion, because since bonus shares are acquired after 1st April 2001, the value of the bonus shares will be considered as 0 or nil. So this will become your gross capital gain. So 11,76,000 minus 1,73,400. So you get 10,02,600. Next we have deductions, which we will do later. So there is a separate topic for deductions, which we shall be doing little later. So as far as the deductions in this question, there is no deduction applicable. So this will become taxable long-term capital gain. So that's your final answer. 15 lakh. If you want, you can summarize total both the amounts. Otherwise, you can just leave this as it is. The choice is yours. So this is how you guys compute the capital gains for financial assets. So if you have any questions, do share your questions in the chat box. I'll reply to your queries.